Do you know that the U.S. pension system is likely to collapse? And did you know that it might wipe out the retirement funds of millions of employees working for local and state governments? In this video, we will get to know about how your retirement savings may be lost this year due to the pension crisis. Stay till the end of this video to know why this pension crisis is happening in the first place and how worse can be the consequences of this crisis. Can it really wipe off your retirement savings? Let's find the answers without wasting time. The U.S. pension system is likely to collapse. Numerous new reports show that the country's pension system is severely underfunded. Many private equity firms are deceiving their clients about their true ability to pay retirees in 2023. The stock market crash is expected to exacerbate the situation, with approximately $4.1 trillion in retirement funds at stake. Worse, the catastrophic collapse of U.S. pensions means that all taxpayers will be financially squeezed by even higher taxes to compensate for such massive asset losses. It turns out, U.S. pension plans, normally known as the gold standard for retirement security, aren't so safe at all. The retirement plans of millions of American employees are in danger, according to recent allegations that our public pension system is dealing with major problems. We first need to discuss the private equity business model in order to fully understand this ticking time bomb that is about to destroy the nation's pension system. Private equity firms frequently use pension funds to buy restructured businesses with the intention of eventually selling them for a profit. Yet, during the buying and selling processes, these companies do not offer open metrics for valuing the acquired asset. Hence, private equity firms can essentially invent a number to present to their clients. Investors in pension plans. According to fresh information published by CNN, Reuters, and The Guardian, these companies regularly overstate valuations while looking for new investments. Feed terms and contracts between private equity enterprises and public pensions are not published to their clients or local governments, in addition to maintaining the secrecy of genuine valuation. And the issue is that these companies have been engaging in this risky practice for a considerable amount of time. And now that the financial markets are becoming more volatile, their dubious strategy is backfiring. Private equity firms informed pension regulators in December that their assets were worth significantly more than they are today. Yet recent data from Reuters shows that all of these companies were siphoning billions of dollars in fees from retiree funds. Private equity firms have experienced write-downs as a result of the recent stock market losses, which has forced many of them to start selling off their assets in order to pay promised retiree benefits. As a result, pension funds now have much less money available than the firms led their clients to believe. Having stated that, there are only 3 possible enrollments for this crisis, and none of them are promising. To make up for the losses, the government might either raise taxes or reduce other social programs, including retirement benefits. Millions of Americans risk losing all of their pension plan benefits if a fourth, miracle option is not soon offered. Pension investments have shifted away from comparatively safe holdings and towards some of the riskier assets in the market over the previous 10 years. Investing in assets like hedge funds, private equity, and alternative investments can boost profits, but they are also extremely difficult to make during economic downturns. For years, our pension system has been in dire straits. All the changes that came about following the pandemic and up until the present day only made matters worse. With a projected 21% loss in 2020 alone, the public pension fund has lost over $1.5 trillion since 2019. These losses have also placed a tremendous amount of strain on a public pension system, and now there is a $4.1 trillion shortfall for state and local pensions. According to calculations by CNN, public pension liabilities are expected to rise from $1.35 trillion to $1.62 trillion this year. These figures are concerning because many governments now have less ability to postpone cost increases or implement mitigating measures as a result of their non-asset cash flow having significantly decreased, as noted by the news outlet. Pension plans still have a serious funding problem, even during the Great Recession's 11-year bull market. Some economists contend that in order to avoid an insolvency crisis and maintain their financial stability, lead fund managers took on risky bets for that purpose. Yet, there was no backup plan in place, and the decision was ill-considered. Currently, funds are finding it difficult to meet their future obligations due to stock market sell-offs. According to official figures, at the end of the previous quarter, just 78.6% of the obligations owed by the 100 largest public pension plans in the United States were funded. A staggering $220 billion were lost as a result of the tech bubble burst between December 2022 and February 2023. Additionally, a number of funds, such as the Houston Firefighters Relief and Retirement Fund, started investing in cryptocurrencies in recent years, and according to a Reuters report, they have experienced unprecedented losses. However, due to a lack of transparency, it is difficult to determine exactly how much money has been lost so far. According to the Ecuador Institute, a non-profit organization that does research and publishes information on public pensions, the combined funded ratio of statewide and municipal public pension plans fell by 6.9 percentage points in 2022, reversing over half of the gains made in 2021. In fact, the report stated that this reduction in funded ratio was the biggest one-year decline since the 2008 financial crisis. Market gyrations become more noticeable when interest rates climb, because more than two-thirds of the roughly $4.4 trillion in assets managed by public pension funds in the United States are still allocated to hazardous investments. The future of American pensions is frightening. Hence, stock market fluctuations continue to affect retirement systems' capacity to fulfill its obligations. Merrill Matthews, a researcher at the Center for Policy Innovation, argued that it is comparable to the gambler who is losing money but keeps placing bets in the hopes of recovering part of the losses. What does it imply now that the market has been in a 6-month decline if the majority of public pension funds were already funded last year? In a report conducted by the Boston Federal Reserve, economists claim that the collapse of pension funds is the most likely scenario to occur in 2023, and the responsibility for fulfilling payout criteria will ultimately rest with the taxpayers they choose. The situation is made worse by the fact that, as explained by award-winning investigative journalist David Sirota, instead of creating regulations to reduce possible losses, American public officials are getting ready to give even more of the savings of government employees to private equity moguls. That is a major warning indication that catastrophe is coming. Wall Street executives who are busy siphoning off retirement benefits near stags want you to ignore this warning. The financial time bomb for employees, retirees, and the governments that fund them, however, could grow the longer the warning goes unheeded, Sirota noted. Private equity returns are a significant danger to pension systems' capacity to pay retirees in 2023, according to a PageBook report from February. Currently, more than 1 out of every 10 public pension funds are held in private equity assets. PitchBook noted a recent study that found losses from the investments are expected for retirement plans that fund millions of teachers, firefighters, first responders, and other government personnel, despite states continuing to keep their private equity contracts confidential. The study from the Equable Institute emphasized that since private equity returns are reported with a lag of up to 6 months, and with a jump date in 2022, values were declining. As a result, 2022 numbers included overstated private equity asset valuations, and 2023 numbers will include those losses. The already overburdened public pension system in California is a prime example of how the recession is having an impact on the economy. The California Public Employees Retirement System revealed that its asset worth had decreased 10.5% from a year earlier at the end of the most recent quarter, a $35 billion loss. In the meantime, Moody's predicts that the state of Illinois' pension liability will increase from $230 billion in 2022 to $261 billion in 2023. Illinois will soon cross the point of no return on its public pension debt, according to the research group. Illinois had the worst public pension debt in the U.S. by the end of 2022, with a debt-to-GDP ratio of 26%. The overall picture is that they are making a lot of money off of their activities, while failing to deliver on their promises, or even what they claim to be giving. Although it is scandalous and shameful that money from the retirement accounts of hard-working Americans is being transferred to the pockets of wealthy Wall Street fund managers, no one appears to be seriously concerned about the implications for the millions of state and local employees who will likely spend their retirement years much closer to poverty than they ever imagined. What are your views on this matter? Do share your views in the comments section. The United States pension fund issue is essentially a reflection of America today, where a power-hungry elite is openly robbing and legalizing corruption in order to take all we have ever fought for. If you enjoyed this video, please check out our other videos. Until then, stay tuned.